A relative who came down from Canada during the year-end holidays kept gushing about the made in India products available in the West. I wasn't surprised initially. India has always been a big exporter of textiles and gems and jewelry. But turns out he was not referring to India's usual exports. Rather, his pleasant experiences were about a low voltage motor, a pair of earphones, and some Apple products manufactured here in India. The gradual shift from made in China to made in India is amply visible to consumers in the West. Should we assume the foreign investors are oblivious to the trend? Maybe not. Electronics maker Dixon Technologies right now is a beehive of activity. It is building a new facility in Noida to make 1.3 million laptops for Taiwanese PC maker Acer. The facility must be up and running in about 4 to 6 months. The pace of activity will only increase. Recently, Dixon won a contract from Chinese personal computer maker Lenovo. The latter is the third largest IT hardware brand in India. Dixon's contracts allow it to assemble laptops and notebooks for Lenovo in India. Do not get disappointed by the fact that Dixon's clientele in these two cases are Taiwanese and Chinese and not American. For the wind beneath the company's tail is an Indian government's policy of providing production-linked incentives. Before the PLI scheme came on stream, Dixon used to assemble about 1 lakh phones a month. With its new factory, the company will have a capacity to make 70 million phones annually. More than 50% of the capacity will cater to the demand for smartphones. With an annual demand of 180 million phones in the country annually, Dixon will control more than 35% of the total capacity. Dixon's global ambition will inevitably bring it at par with the global giants, which are expanding their footprint in India. Hence, it's a matter of time before more American and Korean electronics brands use Dixon's outsourcing capacities. Foxconn, the largest contract manufacturer of iPhones, already does $10 billion in annual business in India through 30 factories. This is 4% of its global revenues. It has announced further investments of $1.5 billion in the country to build more mobile making and component capacity. Plus, it intends to get into wearables and hearables, assemble electric vehicles, and make semiconductor chips. Therefore, India's indigenous electronic makers like Dixon continue to have stiff competition. Over the past decade, Dixon has become a credible manufacturer of television sets and washing machines in India. In fact, it manufactures every third TV and 1 out of every 4 washing machines sold in India. So, Dixon has demonstrated its value proposition in these consumer durable categories. But IT hardware, semiconductor chips, smartphones are the product categories which can fetch the company bigger share of the high value electronics pie. This is exactly why Dixon is focused on these segments. In financial year 2023, it earned 35% of its revenues from the consumer electronics segment, while the share of mobile phone category expanded by 14% year on year to 43%. Now, while Dixon may seem like the perfect stock to buy, its steep valuations could be the dampener for investors. Currently trading at over 100 times earnings in terms of PE, Dixon is valued at more than double the multiple that FMCG major HUL, Hindustan Unilever for instance, trades at. But does Dixon deserve this premium? The return ratios of Dixon and HUL are almost at par. However, what makes Dixon more attractive is its growth rate. The company's new outsourcing deals and swelling order book make it a contender for long-term tailwinds in manufacturing. The PLI benefits, as I said, are added sweeteners. HUL, on the other hand, has seen anemic growth over the past couple of quarters. Growth in HUL's top line and bottom line numbers was dragged by poor volume growth, rising advertising and promotion spends, and higher royalty payments to its parent entity Unilever. The FMCG giant has restructured the distribution margins, with the fixed margin having been reduced by 0.6% to 3.3% in urban areas, and the variable pay has been increased by 1.3% to 2%. Now, this arrangement has irked HUL's distributors. HUL has been pushing direct distribution aggressively over the past few years. It has tried to reach retail outlets directly through its Shikhar app and initiatives such as smart stores and by putting more feet on the ground. Nearly a third or 3 million outlets of HUL's total retail reach of 9 million outlets is now serviced directly by the company. The management indicated that it was looking to plow back money saved on account of lower commodity prices into higher advertising spends. It also get these back to the pre-COVID levels. Lastly, higher royalty spends resulted in other expenses rising sharply. HUL's problems with the distributors can create a low growth bottleneck for the company. Also, growth in the rural areas could be gradual, but the company intends to keep advertising costs high due to regional competitive intensity. So, it is safe to assume that at least in the near term, investors will find Dixon's growth, margins and return ratios more reliable and appetizing than HUL's. Question is how long Dixon will be able to sustain such growth to retain the current valuation multiples. When FIIs chase Indian stocks, especially blue chips in 2024, both Dixon and HUL may be on their watch list. Hope you like this video. Thanks for watching.